Group. Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. On August 13th, Nasdaq and CME Group announced plans to launch a new futures contract based on the Nasdaq-100 Volatility Index called VOLQ. Joining me to discuss what VOLQ is designed to do and what it means for volatility traders is Russell Rhoads, head of research at EQ Derivatives. We'll also take a look at a sample trade employing an iron condor strategy. Russell, it's great to have you with us back on Trade Talks.
Great to see you again, Jill.
So this is pretty exciting news for futures and volatility traders. Give us a high-level view on VOLQ.
Well, VOLQ, the one thing that it has in common with VIX, and we got to mention that one, is that it's going to give you a 30-day outlook or a 30-day measure as far as the market's expectations as far as how much you expect the Nasdaq-100 to move around. Now, the calculation is slightly different, and I like this calculation because it uses 4 different expirations. It uses 2 before and 2 right after that 30-day time frame. It incorporates index weeklies, and then it takes 8 options from each of those expirations. So you have 32 options. It's constantly using 32 option prices to give you a consistent measure of 30-day expected volatility for NDX.
Now, this announcement yesterday with CME Group, you can actually trade futures off of VOLQ now. How does that change for traders? It's another product that they have available, and it sounds like it's more of a pure play versus the VIX, which of course covers 500 stocks.
Well, the thing that I really like about VOLQ, I like the calculation methodology, which is a little bit different because it's spreading things out in case people are trying to trade one event. It's smoothing that out a little bit. It's actually, I think, a better measure of 30-day implied volatility. What's going to be nice about having the futures is you're going to be able to trade volatility expectations. But one of the things that's unique about NDX is the implied volatility of options are a little bit more anticipatory than some of the other broad-based indexes because of how heavily weighted NDX is in just a handful of stocks. So I think that's going to create some really interesting seasonal opportunities for volatility traders.
All right, let's take a look at the sample trade that you have using VOLQ to determine strike prices for an iron condor. Walk us through your payoff diagram and some of the other notes that you have here.
Sure, absolutely. So I've been taking a look at, and something that I've done for a long time is take volatility indexes and use them to give us an idea of what's the market expecting over a very short term. And you can convert VOLQ into a one-day outlook. You can get a 1 standard deviation move by basically dividing VOLQ by the square root of 252. You can get all that in an article that's posted on Nasdaq, so you don't have to try to scribble that down right now. But you can figure out what a 1 standard deviation move is, and I found that if you use that to choose your short strikes on an iron condor, you've got a pretty wide window there, and then go out 20 more points. If you consistently do this using the Wednesday expiring NDX options, it actually has worked pretty well over time.
So you've also noticed that VOLQ is likely overpriced relative to the realized volatility on Tuesdays because of that Wednesday expiration. Tell us more about that.
It is. That was the first thing that I found that was pretty interesting was you can convert VOLQ to that one-day move. And so I looked at where did VOLQ close on Friday and what was the move on the subsequent Monday, and did that for every day of the week. The closing VOLQ on Tuesday is the one that is most likely to overprice the following day's price move. So, options, we do believe that options overprice subsequent realized volatility slightly on a consistent basis, but it seems to do this a little bit more so on Tuesday going into Wednesday. And since there are PM settled NDX options that trade trade Tuesday and then have 1 day of life until expiration on Wednesday, it actually gives you a really unique short-term opportunity to play that consistent overpricing of implied volatility. And using VOLQ gives you an idea as to, are we in a high volatility environment or are we in low volatility environment, and helps you choose the strikes by taking VOLQ and converting it to that 1 day predicted move, which 76% of the time is overstated relative to the subsequent Wednesday move.
So Russell, for newer traders in the audience, this is clearly different than your typical regular way, third Friday of the month expiration. Index options are certainly different than single stock.
Mm-hmm. So the Index options tend to have a pretty consistent implied volatility expectation. It shifts around over time, but it doesn't necessarily it's not forward looking. It's actually more reactive to what's going on in the current market. So when you have VOLQ reacting to the type of volatility that we've had in 2020, it's going to be elevated, and it's going to give you an indication that you need to spread out the short strikes on an iron condor somewhat. That's not necessarily true for individual stock options. Individual stock options have more of an anticipatory nature. Options are pricing in what we're expecting to happen over a certain amount of time. And if a company has a certain announcement coming up, usually earnings is the one we use more than anything else, implied volatility will adjust for that. And I've actually found that trying to do the same thing with individual stock options that I'm talking about right here really doesn't work particularly well. And it's just because of how individual stock option implied volatility is a little bit more anticipatory than broad-based index option volatility.
Certainly an important distinction to recognize, Russell. Thanks so much for joining us on Trade Talks.
Bet. Happy to be here. Thanks.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.